X Down podcast.
This is a place for the prudent crypto investor, gigabrains, devs, founders, and moonboys. Quick disclaimer. This is not financial advice. We're just trying to make sense of the madness that is cryptocurrencies together. I'm your host, Sira. I'm joined today by Fred, aka Material Scientist, together with fellow DED counselor, Ape. Fred, if you could tell us a bit about yourself and the different tools and indicators you created and provide at materialindicators.com.
Sure. So yeah, my name's Fred. I'm based in Switzerland, and I don't actually have any financial background. My background is chemistry. So up until last year, I was a PhD student in chemistry. But before that, all the way back to 2017, I had already joined crypto, invested in Bitcoin for the first time, even though I had heard about it, way back already. And the whole aspect of trading just fascinated me. And I thought it was really cool that you could, earn an income from working from home and be in control of how much you earn if you do it right. And that's when I started trading, and eventually I wanted to systemize it by looking at indicators that might be helpful. And the first one I tried was just a simple trend following model that turned out to be one of the indicators that we offer, which is trend precognition. But I realized that trend following doesn't work so well when things are consolidating. So I also looked into mean reversion, and that worked well during these consolidation periods. But it still, lacked some aspects, such as how do you know when things are going to mean revert? When things actually have support and where's the resistance? Because if you just look at price data, you don't have explicit demand and supply levels. You just have implicit demand and supply levels. And using more granular data that was not available on TradingView, I started collecting exchange data such as order flow and all the order book events, and started reconstructing the order book myself to really visualize explicit support and demand, supply and demand levels, and combine that with the other indicators that we have. Mostly for, I myself mostly do discretionary trading, even though we have some automated bots using mostly MTF as a strategy.
Okay. Sorry, but I'm just kind of surprised and impressed at the same time, right? So you only basically started trading in the past couple of years, and then you created these algo trading systems that I'm assuming you've seen a lot of success in. Is that right? Like, I've never used them. I haven't. We haven't really gotten deep into them. So I'm curious. Like, has it been successful? Were your indicators able to tell you about maybe the drop that we've seen in the past couple of weeks?
Oh yeah. I mean, that's also how I was able to capitalize on that. But really, what it boils down to for me is that it's just a never-ending rabbit hole, right? You have one metric that you investigate, and it's never enough, and then you just keep digging until you're happy. But the problem is that you're never gonna be happy, So you just keep digging, find new metrics, find new ways to figure out the directional bias and reduce drawdown, and just generally try to improve.
I think that's the data science approach that is being practiced by you and many data scientists across the world, where you have a system, you have some information, you have some thesis, and you find that you're missing some information, and you start looking for more to fill that gap. and then you realize there is something else missing, but you're always improving your model with new information, or actually disregarding some information in some cases. But yeah, I see that in your approach too, which I
Yeah,
really
exactly.
like, because I feel I've been through that same route myself too. I haven't built a full data science platform or a full trading platform, but I have looked for these indicators too, where I felt that a lot of this support and resistance was assumptions, and of course people act on those assumptions, but it's not always the case. And when, does that assumption fail, and when you have to flip that bias. So it's
So
really nice you acted on that.
yeah, I mean, most of the stuff that I built, I just built for myself to improve my information on the market, right? To really try and understand what's going on. But showing this to other people, we saw interest, so we decided to make this into a product and offer it to them as well. So that's when Material Indicators was founded, I think in 2018, 2019, with my partners from Florida. That's Black Knox. And together we offer, all these metrics as a service to others who might be interested in, looking at these metrics.
Mm-hmm. Do you mind sharing your screen so that we can take a look at these? I'm also curious to see if, so I think do you have three main indicators? Is that right?
Yeah, that's right.
And do you use them? Is one better to use than the other? I guess you can go through it when we go through every indicator. I'm going to put you guys on shared screen.
So actually, I don't just use them individually, but rather more together, to find some confluence and try to piece together a story from all the aspects. You have trend following, you have mean reversion, you have supply and demand, and then on top of that, I try to add some macro outlook depending on what the rest of the world is doing. Nowadays, crypto is well established also in the institutional space. Institutions have joined at the rapid pace since last year, and we can't just look at crypto only, but rather look at the bigger picture, because they all trade as the same now.
Absolutely. And this is why I'm in 20 minutes, in 21 minutes, New York opens. And right, futures are down. It was up for like a few hours last night. I'm in New York, by the way. And I think a lot of us are paying close attention to how this opens. Right now, it's not looking too good. And we will see how that's going to affect Bitcoin. But yeah, you're right. You have to pay attention to all of these things.
Mm-hmm.
So what we have here on the screen is your heat map, correct? Just the heat
So
map?
this is actually what we call fire charts, because the default heat map is the fire heat map, and internally we just jokingly called it fire charts, but it's stuck. So that's why now
I see.
everybody knows it as fire charts. And yeah, this is actually the new unreleased version. So this is the beta version. Our current version in production is still fire charts 1.0, and it looks like this one, right? You have the ticker that you can select, the exchange. Currently it's only Binance, but we'll have more later. And then you can look at different periods. You have low time frame data, you have high time frame data for the order book as well as the order flow. So the top panel here shows the order book, where you see the price levels on the y-axis for BTC USDT, and the volume is actually represented as the color. So dark means low volume. So these are resting orders, right? Limit orders, bids and asks. And a bright color means that there's a lot of volume denominated in USDT. And the bottom chart shows the order flow by order size. If you only want to look at trades that are of the size $100 to $1,000, then you can look at the orange curve. If you only want to look at trades that are of the size $1,000 to $10,000, then it's the green curve, and so on, up until whale-sized orders up to $10 million. And if you want to have the cumulative volume delta by, for all of these combined, then you can look at the blue curve, which is what most people do. Is just look at the sum of all the orders and not binned by size.
Correct.
But
sorry.
yeah, I mean, this is if most people don't look at it in a normalized fashion, they just look at the absolute values, right? So, for example, in the last 24 hours, the peak of the CVD was at plus 40 or 50 million or something like that, and then it gradually started dropping back down to a net volume of minus $60 million. But as you can see, the higher classes, so the bigger order sizes, they don't trade as much, and it's hard to see them. And that's why we normalize them between 0 and 1, so you can see all of them overlaid. But yeah, this is the first version, and then the second version is a bit fancier and includes some more features, such as you are able to now adjust the size, the order size, so the color scaling, as well as look at different windows for not just the order flow, but also the order book. So, for example, this is the last year of Bitcoin history on Binance.
I see. This is really cool. Really fascinating to just have the visual of it. So I'm currently trying to learn how to use. Have you heard of exo charts?
Mm-hmm.
Right. So it's similar, but like you said, I guess we're only paying attention to the blue, to your cumulative. What is it? CVD, right? In exo charts. Like you said, that's what most people look at.
Mm-hmm.
And it's just, I guess, cool to see it displayed in a different way like this. What I guess looking at the CVD and the recent volume, what do you think about how we've seen decreasing volume really since that May drop, right? So we had just huge weekly candle volumes, I guess, on the way up, from the COVID lows up to the previous all-time highs hit in, whenever that was, February or January last year.
Mm-hmm.
And then we just had steadily decreasing volume on the way down and back up to the more recent all-time high, and then now still very low volume. What do you think about that?
So I don't look much at volume, and also the volume that is displayed in TradingView shows you the volume in number of contracts, or the base units. So it's the number of BTC that was traded. And as price rises, of course, you have fewer BTC traded, but more dollars traded. So that's why I don't really look so much at the volume, at least not in base units, but rather look at the net volume, so that when positive, market orders that are buys are denominated as positive quote volume, so in USDT, and the market sells are negative volume, and when you combine them, you get the CVD. And what's been really interesting is that, as you can see, if you look at just the raw CVD, so the blue line, it doesn't really tell you much, right? It's down only. It always goes down on Binance, at least. And that's, what originally compelled me to look at the bin CVD, because the raw CVD was kind of useless.
Sorry, you said bin CVD is different?
Yeah, so if you look at the CVD binned by each order class, for example, the 100,000 to a million order class, you get a little bit more information on the order flow, because it just so happens that, at least on Binance, the higher or the larger orders have more influence on the market than the overall CVD. I mean, there's just constant selling pressure, and a lot of that stuff is just noise.
Mm-hmm. Wow.
And what insights have you got from these specific bins? Like, are you following one specific bin for the direction of the market, or a combination of them?
Yeah, so the purple line, so the $100,000 to $1 million order class, was actually the most influential on price action. You can see that the other order classes don't really have big swings in their curves, but the purple class shows you spikes as at the same time as price action here. Here's another spike, then here's another spike, here's another spike, another one. But what's really interesting, and that prompted me to question back in April, May of 21, was the divergence between this purple order class and price, right? So price made new highs, while the purple class made lower highs, and that to me indicated just profit taking. And I also talked about this back then, but I just really underestimated the effect it would have on the market. I thought it really was just profit taking on the way up, and it would just keep going up. But in fact, it was just a distribution top, right? We know that now in hindsight. And what was particularly interesting during this downtrend, to 30K, was that this one order class, this purple order class, didn't buy a single dip, right? They just sold every spike, even though price action spiked here. The purple class just sold them all until the end of July, and this is the first time they started buying again, and price followed. And once they started selling off again, price dumped. Here they bought again, and we made new highs, but they stopped buying here at this point back in what was it, mid or end of October. That's when the ETF was announced, right? And from there on, they just really sold every spike, even this latest new all-time high where we went to 69K, right? They sold it all. And what was interesting in terms of the order book was that at the same time, this range in liquidity was created. Maybe let's in a bit more, where one entity, and I say one because they appeared both at the same time, right? You had this resistance and support that appeared at the same time. So one entity placed around $200 million, I think, if you combine them. So this one is 50, and then you have another 100 here, and eventually here even more. They created this range, and Bitcoin was just stuck in it. And at the new all-time high 69K, we actually tapped the top of this range and immediately rejected, even with more resistance. And I was just waiting for the bottom here to be tapped, which eventually happened. And this is actually where I thought we were gonna bounce and maybe continue the bull run. But a few hours, so this was at the end of November, and right around that time, there was a FOMC meeting, right, with Jerome Powell, who had acknowledged that inflation was no longer transitory. And to me, admitting that there was now rampant inflation, and that they had to do something about it, just meant that really they were going to accelerate their plans to taper and rate hike, which was then later confirmed. But the way the order book reacted to this information really was concerning to me. So a few hours before the meeting, these bids here were pulled. And during the meeting, we saw a lot of these asks being stacked up here as resistance. And this is really where I got out. I sold everything. And a few days later, we dumped back down, and we just kept dumping until we had some support in this area, mid 40s, low 40s, where I tried to maybe rebuy some of my stack, but I just gave up once I saw that they had pulled these bids here again, and there was just no follow through. And eventually we kept dumping more, but now we have some more support here at the low 30k. There's just no order flow yet to support it, but maybe this time we will see one more last bounce. But really what you should be doing in this kind of market is not buying the dip, but rather trying to sell the bounce or short the bounce, in my opinion.
Fred, I have a few questions. This is awesome. So you said that it's dynamic, meaning those bid orders and I guess ask orders were there and then disappeared, meaning to say it was lighter in color and then it became red, and you can see that happen.
Mm-hmm.
And
yeah, you can see them disappear.
Wow. And then that top light band, right? I guess in the 70, yes. You said that and the bottom one appeared at the same time. Like, what does that tell you?
It just appears to me. It indicated that one entity was trying to control the market, because they both appeared at the same time. They created this range.
Wow.
And that was really concerning to me as well. How can one entity control the entire market for almost 2 months?
That's insane. And then it was like, how large are these bid and ask orders?
So at the top here we have 84 million plus another 70 million, and here at the bottom where we started bouncing, there was another $120 million.
Wow.
Maybe more even. Once we went a little bit lower, there was more.
Okay. And then you said that you pulled out. You saw that there was some support, right? I guess right in this 56,000 area, and then you pulled out when you saw that the bid was removed, right?
Yeah, so the bid was removed a few hours before, but sometimes when that actually happens, when they remove the bids, that's exactly also what happened at the 30k bottom, right? They had a few hundred million in support here, and then just as we made the low on the daily close basis, I think they removed those bids. And we started pumping. Sometimes this removed liquidity is used for market orders. That they no longer have a need for resting liquidity, but rather use this liquidity for market buying. So there's always a chance that when they remove bids, it's going to be used for market buying. And in this case, that's also what happened, right? They removed the bids and we started pumping. But what was really concerning to me was that they, during this meeting, during the Jerome Powell meeting, they stacked a lot of asks, and this was just really, a sign that the price was going to get hammered down.
Got it. I see. And I believe it was December 4 where we had that liquidation period. Is that where this what is it? Okay, yeah, so that's exactly where it was, right? That's December 3, December 4.
Mm-hmm.
Okay, so I look at, on TradingView, I use the fixed volume profile, and at 56k, it was December 3, like 12 hours or something before that liquidation event. I was in a trade, and in my mind, it was $56,000 is the point of control and the resistance that has to, or rather, it's the support that needs to hold. when it broke, when the first 4 hour candle closed underneath 56K, I exited my long trade on Bitcoin and I sold out of all of my altcoins because I was thinking, all right, this is probably going to go down to 50. Little did I know, right? We cascaded all the way down to 41, and my entire sort of thesis changed, right? Essentially overnight. When we got back up from that bounce to 42,000, I think we went back up to like 50, 51, 52. That's when I started selling my Ethereum at those levels as well, because it was just, to me, the risk reward was no longer there for me to hold on to my ETH, and then we started just dropping from there. I was fortunate enough to hedge my. I don't sell my Bitcoin, but I was able to hedge it because I entered a short position around 52,000 the last time we hit 52K, and it was an amount that was more than what I'm holding in spot. So I'm like happy, but it's amazing to see that there are so many different ways that people can come to that same conclusion, right? So I was looking at one thing, you were looking at the other, and we both sort of played it out very similarly.
I mean, what was additionally concerning to me was how all the super rich started selling all at the same time, right? You had Elon Musk, who maybe tried to disguise his selling through this Twitter poll. Maybe blame Twitter on him selling his Tesla stocks. You had Jeff Bezos, who sold also around this time. You had even Jerome Powell selling. That was leaked, I think, by Zero Hedge. Or 2-0 hedge, and even the Microsoft CEO Satya Nadella sold a bunch, I think 50% of his Microsoft stock, all in this time, this time period of October to November. They all sold here, and that was really concerning. That was an additional confluence to me that maybe this is not just gonna be a bounce, but rather a dip that you don't want to buy. And also, I really like this quote by Ray Dalio, and it says, when credit is easily available, there's economic expansion, and if when credit is not easily available, there's a recession. And tapering and rate hikes really is just that, that they try to squash the demand side of the market quite literally. In order to squash inflation, they can't affect the supply side, which is why we still see rising energy prices. There's just a shortage of that, but they can control the demand side of the market. And really, if there's no demand to buy crypto, what's the point of buying the dip?
Yeah, scary times. You're 100% right. Why buy the dip if there's no demand for it? And now this, I think, crypto Twitter's, I'm seeing a lot of posts saying, Peter Schiff must be celebrating because gold is doing nicely in the past few weeks while Bitcoin is down. So there goes the, store of value narrative. I personally think that Bitcoin, yes, as I guess as a human being, we need to find something to compare it to that is whatever it is that is closest to. But the reality of it is that it is not anything that we've ever seen before, right? This is new technology. So you can compare it to as many things as you want, right? First, they're comparing it to a currency because it was labeled cryptocurrency, but that's not what it is. So it'll be very interesting to see what happens, in the next few months, because I personally I would buy it at $20,000, right? I mean, I'm not selling my Bitcoin, but I will buy more at these levels. In fact, even now. So what's interesting to me as well, right? You have these high volume. How do you say this? High volume color or
Yeah, sure.
So you have these high volume colors in that last year May to July range, right? And
hmm
I have my using the, what was it, the range profile, the volume profile. I have that point of control from that range in May to July as a level that I'm looking out for right now, right? Which sits, I think, at like $32,000, $33,000. And that um, that volume where it sits, where my volume profile sits, is right where you have this high or this light color, this bright color on your chart. In that,
30K here.
yes, exactly. So it's
Yeah.
the same. It's the same. Even if the demand maybe is not there, I would still certainly buy there, right? Despite all the narratives, it's not gold, it's going to keep going down. No, it's still a level that is worth buying, because technically you should see a bounce there from what I see. Now, from what the fire chart shows, is the same, right? It
Mhm.
looks like there are some heavy bids down there in the levels that we're looking at.
Yeah, so we're cycling back to what Fred said in the start of this podcast, where you have the assumption it is a support from your analysis and from the assumptions about your volume profile, and you can add that to what Fred's data is showing us.
I
That
know.
there is that
That's what I'm
confluence.
saying. It's amazing. It's
Yeah,
the
that's cool.
best. It's like it's another level of confluence, because that's all we need as traders. It's multiple levels of confluence to tell you that this is when you should enter the trade. So I
Yeah.
personally I don't care what what's going on crypto YouTube, crypto Twitter, because they're probably not looking at the same things I'm looking at. And if I had the fire chart in front of me, that would just give me immediate confidence, or a lot more confidence in entering my trade. Maybe I'll double my position, at that price.
Yeah, I mean this was really the point, adding confidence, trying to reduce the risk, having the supply and demand explicitly in front of you.
Now, what you would want to see is, would you want to see an increase in CVD when we get there, like maybe lower lows and prices with an increase in CVD to show you that bullish divergence? And then what are you going to do?
So actually, maybe let's go to a different metric, which is just the funding heat map. So a lot of people in the low 40s were just waiting for a bounce based on negative funding, which is usually a fair argument, because this is also what happened back in the May to July's phase. So first of all, let me explain the chart maybe. The top panel here shows the Bitcoin price, right? You have the price scale on the y-axis. You have the time on the x-axis. Then this middle pane here shows the funding rate for every single pair on Binance. You can zoom in here on these, right, to show all the pairs. And the color is just the funding rate. So negative is blue and positive is red. And neutral funding, is just this gray color. So what it shows is that, a few things. First of all, funding is very correlated across all the assets. So, that you have almost uniform funding rates across all assets. So it's not just funding that is based on, coin to coin. And then you have these periods of really high funding that indicate that you may want to take profit, especially, here and here, as well as this period here, this August top, which lasted for about a month. But what I really want to mention here is the negative funding period from May to July, right? Almost all the pairs had either negative or neutral funding, but none of them had positive funding. And now we see the same thing, right? We have a lot of pairs that have negative or neutral funding, but none of them have positive funding. And the bottom here, the bottom pane here shows you the quantiles of of all these funding curves by percentile. So it's the second percentile, the 98th percentile, and the 50th percentile. And at the very bottom, you see all the pairs on the x-axis and the funding rate as of the last update, which is a few hours ago. At every 8-hour closing period, you can see the latest funding. So for example, for XM, it was 0.32%.
Sorry, Fred.
Now,
what is a quantile?
So this is just, it shows you that 2% or less. It bins all the data points basically into 2% or less had lower values than this or this, red one. 50%, 50th percentile is also the median, and on the 98th percentile, you see that the what should I say? The flip side of it, basically, of the second percentile.
Okay,
Yes,
But-
and
yeah.
so data scientists often want to look for extremes or what's abnormal. And to do that, you can do that with these numbers you get from the exchange, because you'll get some, different spreads in these fundings. So they normalize that. So you have distribution, and in the distribution, you can put in these quantiles, and you can see what is more near an extreme or just in the middle. And I think what this map really nicely shows is, for example, around that 60K top in Bitcoin, the funding was really extreme if we compare that to the periods before that. And that's why these are quite in the red.
Got it.
And now we actually start seeing that they are going into the blue a little bit, but not across the board. But it surely is interesting to see how it shifts like this over time over all these assets in the market, which we know are quite correlated. But this is another good example how you can visualize that with, for example, the funding rate.
Yeah, I mean, just purely based on the funding rate, it could have been a very similar environment as the May to July phase, right? There was, not as many negative funding pairs, but it was quite similar. The only thing that really made me doubt a bounce, in the last few days in low mid 40s was not funding, but options flow on Binance. So this is Binance Vanilla options. And I'm looking at the put type call options CVD for all expiries, starting from the very first one when they started the API back in early 21. So this shows really the options flow, the CVD for put type options at each price level. And the unit for this is not USDT, but the number of contracts here. I have actually both of them. I have the funding not the funding, the CVD in USDT, but also the CVD in number of contracts. And what's really concerning here is that, or let's maybe start back here, in April, May, we had some put buying. So this is all the red stuff, right? Positive order flow is red and negative order flow is blue. We had a lot of put buying below strike in this April-May phase, and it just kept going until the end or middle of July, right? And then it flipped, right? They started selling puts below strike, so out of the money puts were sold, which is usually a very bullish sign, right? If you only sell options when you expect price not to go there. And so they, the selling of these out of the money puts was really an indicator of these players expecting price to go higher, which eventually it did, right? So this was actually this was leading price action by a few weeks, and eventually we did go higher. And the same thing happened again in October, right? They still kept selling puts, but then it flipped. They started buying puts again, and right now we're still in this buying put phase. We don't have any sold puts yet, and this really just makes me doubt that we're already going to bounce, or that maybe doubt that we're going to bounce at 40K, and maybe
So-
now we already see some put selling, but it's not enough yet, I would say, just based on this alone.
So what you would expect to see is when puts start being sold out of the money, then CVD is going to go down. Is that right?
So yeah, when puts out of the money puts get sold, and we will see some blue CVD below the strike price, and that's one of the metrics that would make me a little bit more bullish for a bounce. But right now I don't see it yet, so I will just keep stay cautious.
So I don't trade options, but when you say strike price, when you say you want to see blue underneath the strike price, that's not the market price that's shown on the line graph, right?
No, this is actually the spot price that is overlaid. I don't think anyone's displayed information like this. It's just really condensing all the options data to make informed decisions on the underlying asset, which is spot Bitcoin. I'm just using options data to figure out where spot Bitcoin might be going, and I'm not really actively trying to trade options, but rather use options data to make informed decisions on spot trading.
There is an assumption, I think, here that the options market is becoming more important because in the past we mostly looked at futures and those order books and liquidations and stuff like that. But recently, I think in the last year, maybe even last half year only, options flow has become much more important. What's your opinion on that? Of course, you build a tool already for that, but what's your idea on what the influence of options will be on the crypto market?
I definitely think it's picked up, and from the sources I have, I know that there's a very large interest in options and crypto options. I don't think yet that the options market is big enough to really cause have a causal effect on spot price action, but rather I think it's more informed traders. It's not the retail flows mostly. It's more the more expert traders that trade these types of products. And I think that's where you get more informed order flow, which can be useful to make decisions for the underlying asset.
Meaning to say, we need to get your indicators out there to retailers so that we can start playing against these institutions who seem to be making it difficult for the retail guy to make some money in this market.
I mean, definitely it's looking at all these different aspects of the market. I think it helps to make more informed decisions, that you don't just trade one metric, but that you let the decisions of all these various metrics influence your final decision.
I think that's really unique in crypto, where we have actually an abundance of data available, where normally in traditional markets there would have been, these subscriptions would be very expensive, or you only get access to it if you're an institution. But in crypto, you can get data from all these sources. For example, from a dashboard like this, and trade actually like a professional. So I personally, I'm not always, I don't always agree with the statement that the retail guy is getting run over by institutions, because you can actually trade yourself like an institution. You can trade with them with this data. You just have to figure it out or have the right tools and know how to use these tools in the current game that's called the market.
Absolutely. No, for sure. I mean, I think most people don't know how to trade. Most retail, when I think of retail, it's people who think that they can make easy money very fast entering in crypto. Oh, like, look, I'm trading, and they tell all their friends I trade. But the reality of it is that they have no freaking clue what they're doing. And trading is incredibly, incredibly difficult and takes a lot of time to learn what it is that you're actually doing. And that's really why people keep getting wrecked. And I mean, I think it's who said it? Ivan on Tech said that it's like the national sport of cryptocurrencies is to buy high and sell low, and that's because our brains are wired to feel safe buying when something is in an uptrend, and to feel safe selling when something's in a downtrend, to protect ourselves. When the people who actually know what they're doing obviously know to sell at the top and buy at the bottom. Now, finding that is where it gets tricky, and these tools can tell you. It can find that for you. So this is great, Fred. This is awesome.
Thanks.
So chemistry is out the window.
Yeah, I think I'm more interested in trying to understand the market. It's just really it's like a burning hunger. You're never satisfied. You just keep digging.
Yeah, and you said this earlier. You said something that resonated with me, and I think Ape also mentioned it as well. Like, you are constantly learning new things to add to your model to make it more accurate, right? That's what I am doing as a trader. I'm constantly trying to learn how to read new things and indicators so that I can get better. Do you think at some point there will be like maybe this is more of a philosophical question, but do you think there will be a time where traders like myself, who are not algo traders, will be sort of wiped out and no longer needed, because there will be tools in existence that people can use that will just tell them when to buy?
I don't think so. If this becomes too adopted, then it itself will change the market, and new patterns will emerge, right? So whenever you interact with the market, you change it, and as long as the influence is not too great, I think this stuff will keep working. But once people catch on, it'll lose alpha.
Interesting.
But that's why you keep digging to come up with new stuff.
That's
You
really
you
cool.
want to be doing mistakes so you can learn from them.
Yeah. So I follow, rather, I'm teaching myself how to trade. Like, I don't know if you've heard of the YouTube channel Chart Champions, and the main guy there does the same thing basically, right? He tests out new ideas because he knows that what's working now may not work a year from now. So that's really cool.
I think we discussed most features of the platform, and I think it might be time to wrap it up. But I think I want to ask a final question where you see global markets and also the crypto market in the next few months or maybe in a year, and how you would be using your tools to see where you want to buy or what you want to see for a prolonged period for crypto to survive.
Yeah, I mean, let me just mention what you guys talked about before, which is how gold was resilient in this downtrend period. And actually, there's in trading, you can't just rely on metrics that will keep working. There's also, regime changes, such as, how the economy is currently changing, or rather how the monetary policy is affecting it. So right now we have low economic growth and a high inflation. I think 7-8% almost on the CPI, officially reported numbers, and that just sounds like stagnation inflation, stagflation from back in the 70s. And when we look at what outperformed back then was, after the initial flush, of course, during crisis, all correlations go to one because they also use these as collaterals to cover their other positions. But, after the initial flush, commodities and hard assets really outperformed, while stocks didn't really perform at all. That was this decade from the 70s to the 80s. We had 3 recessions back then. We had rate hikes under Volcker that went up to, I think, 20%. And now we're in a similar situation. We have a tight monetary policy with rate hikes and tapering. And we have low economic growth. We have high inflation. We have energy prices exploding just like back then. And, gold is being bid. So I think after the initial flush, we might see a run towards commodities and hard assets again, and not really stocks performing. And given that, I hope, since this is the basic promise of Bitcoin, that is, supposed to be hard money, that Bitcoin might also be among these assets after the initial flush, of course, because right now it's a risk asset rather. But what's also maybe really concerning, and this was brought up by Volatility Quant, VolQ in short, is that the bond market has shown a negative correlation to the equity market for the last 20 years, right? And people are used to this, so they could just hedge equity risk with bonds. But this doesn't work during a high inflationary period with tight monetary policy. And in those environments, the bond and equity correlation has been positive, so that when equities dump, bonds also dump, and vice versa. And I think maybe not everyone is really prepared for this. And what can they hedge with if not bonds? It's gonna have to be hard assets, right? And such
Real
as
estate,
gold and silver and real estate. Yeah, exactly.
Yeah, frightening times indeed. And you're right. I mean, people are going to get wrecked. People are absolutely going to get wrecked, especially now, with Robinhood and all these people who are just dabbling in the markets, like as not even as a side hustle, but maybe even, yes, as a side hustle, because it's so easy now to do, right? So now that we have more people, especially people maybe my age, millennials and these kinds of stuff, early 30s or whatever, who have that extra cash to play around and trade with on Robinhood, like if they're not careful, or if they're not expecting it, like you said, like they're going to get wrecked. And it's just kind of crazy to think about that.
Indeed.
Oh, all right. Well, hey, Fred. So to wrap it up, thank you so much for your insight. Like, this was amazing. We had a great conversation. If you could just tell our audience, where can we find you?
So yeah, thanks for having me, first of all, and it was fun joining. And you can find me on Twitter under Material Scientist. Here's my Twitter page.
Oh,
Hashtag material_scientist. Same in Telegram, but also you can go to our website, materialindicators.com, and check out our community, our tutorials, our products, and come say hi if you want to.
Amazing. And hey, just out of curiosity, how large is your team?
Currently, it's 5 people.
Nice. Okay. Fred, thank you so much.